Good afternoon. Welcome. Thank you for joining us. Class is in session. My name is Michael Filer, Managing Director of Private Wealth Management with Palisade Capital. I've been with the firm since its founding 26 years ago, although our roots trace back to 1969. For those who may not be familiar with our firm, we are an independent SEC-registered investment advisory firm who act as a fiduciary on behalf of our clients. We currently manage over $5 billion in assets, 2/3 for institutional clients and the balance for private wealth families. We focus on fundamental, bottom-up, research-intensive investing. Today marks the second session for Palisade University, a newly created platform to provide investment education for clients and prospects covering a wide array of topics. Previously, in the first session, we covered the basics of fundamental investing and highlighted the role stocks play within portfolio construction. In today's session, we will discuss the importance of bonds and how it's utilized as we build out portfolios. Today's webinar, once again, will be given by Todd Rosenfeld from Securities Training Corporation. Todd is a longtime friend of the firm who possesses a wealth of knowledge and experience on this subject matter. Incidentally, my father, Jack Filer, worked with Todd in the mid-'80s. Together, they trained students to become stockbrokers and advisors. Again, thank you for attending this virtual event. And without further ado, I will turn the program over to Todd. Todd, great seeing you.
Great seeing you too, Michael. Well, first of all, thank you everyone for joining us. And I'm awestruck by the view behind me of the George Washington Bridge. This is a great place to do a class. So let's get started. Sorry about that, my computer just locked. We'll get started. First thing we're going to do is go through a little introduction. Our agenda today will be why invest, asset allocation, equity versus fixed income, with, of course, an emphasis today on fixed income, as well as volatility in the marketplace, bond basics, some terminology, the all-exciting yield curve and understanding what yields are, a little bit on credit and default risk, non-credit related risk, hybrid securities, type of investment risk, and last but not least, diversification, moderate asset allocation, and an example. So let's get started. And we went through this, our last presentation, talking about the time value of money and compounding, where $1 today is not worth the same as $1 to be received 20 years from today, referred to as the time value of money. And one of the most interesting things, and especially when dealing with fixed income or bonds, is compounding. The idea that you invest money, you get a return on that money, you then reinvest that money, that's key, and then the earnings generate. Now, in stocks, it's dividends, and bonds, it's interest. And remember, not all stocks pay dividends, but all bonds pay some amount of interest, some more, some less. And of course, we'll deal with inflation, inflationary risk, where we're talking lately about inflation, high inflation, which many of you have not seen, many of us have not seen in many, many years. So let's take a look at the interesting chart and graph on the right-hand side of the slide. And it refers to retirement. So if you started at age 25, okay, and you invested your money and earned a return, an average return of about 8%, put in $10,000 on an annual basis. At age 65, that money would be worth a little less than $3 million, $2,797,000. If you waited to 35, it'd be substantially less. And if you waited to 45, even less. So the objective here is the earlier you start the money, the beauty of compounding.
Todd, it's worth mentioning again, I love the Einstein's famous line about compound interest. Compound interest is the eighth wonder of the world. So it shows you through good times and bad times, people love the constant cash flow, the constant interest hitting their portfolios.
And who doesn't like looking at their account statement and then seeing, oh, the value of what it was and the value of what it is today? It's grown substantially. So it's really good. Unfortunately for me, I'm closer to the 65 versus the 25. But again, I still invest in a mix of stocks and bonds. Again, one of the big issues is inflationary risk, as many people like to point out. So a little bit on asset allocation, just kind of got to set you up. On the equity side, we have U.S. equities, which consists of large cap, mid cap, and small cap. And again, from our previous session, cap refers to market capitalization, which is the number of shares outstanding multiplied by the current market price. As you see, the market cap of a stock like Tesla can vary greatly from one day to the next. And then we have mid cap and small cap. And then we have international equities. And you might have heard the term global. Global is a mix of both U.S. and international equities. And on the all exciting, it doesn't get as much time. People don't talk about bonds enough, and it's really important. Or fixed income securities. We have municipal bonds, or people like to call them munis, convertibles. We'll have a separate slide on hybrid. And when we discuss hybrid securities, I'll spend a little time on convertibles. Then we have government bonds, or better known as treasuries. And then corporate debt, where we deal with investment grade and high yield. And we'll go through what makes up the difference between those two.
And periodically, Todd, we'll get the question from folks. I see a question just came in from the queue about what's the typical sweet spot between stocks and bonds to mix. And again, more recently at Palisade Capital, we've introduced financial planning, which is a great way to really get to know people's cash flow needs, their risk profile, risk tolerance. Ultimately, the plan really helps us. The plan itself becomes the engine that drives the asset allocation. And again, there's no cookie cutter approach. It's really a case by case basis.
Well, and it can change. You know, as one has children, they go to college. You have to go to college. They there's bar mitzvahs and bat mitzvahs and weddings and all sorts of things that you have to plan for. Second home, people moving out, value of real estate has changed, other securities, other investments. So it's a constant ebb and flow. Financial planning is usually important in that.
This is far from a set it and forget it. It's constantly evolving. You got to keep up with the various changes.
Yes, always. And no one size fits all. So two people could be of the same age, same income level, and their needs might be totally different. So a little bit on the comparison between stocks and bonds. So we talked about equity securities. They're issued by corporations. The owners are called stockholders. If there's a return, it's referred to as dividends. Some companies pay no dividends. Some companies pay higher dividends. The risk will be higher. Just look at some of the volatility that has happened in the equity markets over the last few months. We've had good days, we have bad days. You can also vote when you own stock, and stocks are traded on most exchanges, which provide a great deal of liquidity. On the other side, fixed income securities is where you're lending money to some issuer, a government, corporation, and they are agreeing to pay you back with interest, which is pretty good. It's a constant level of interest. The issuers, as we'll see in a few minutes, are the government, the U.S. government, financial institutions like banks, insurance companies, saving institutions, corporations, and municipalities. The entity, you don't own equity when you own bonds. You own you have credit or debt. Your payment will not be dividends. It'll be interest or interest income. The principal is generally not guaranteed, but depends upon the issuer. And the majority of issuers have a very low, what's called default rate, and we'll go through that in a few minutes. And the risk is relatively low. We're going to see a really interesting chart on the next slide that shows the volatility of debt versus equity. If an issuer would go default or happens to go bankrupt, debt holders have a higher priority in terms of the repayment. And last but not least, the market for debt is different than the market for equities. There is no exchange for debt. So the idea is many large investment firms maintain inventories of bonds. They buy them directly from issuers or buy them from institutional investors and then resell those securities from their inventory. And there are some issues that are highly liquid, and we'll go through in a few minutes. Some issues are less liquid, harder to sell. So with a lot of liquid issues of bonds, they're not as easy to sell as equities, but very close to it. There's always a way in which you can buy and sell debt, and which is pretty interesting.
And Todd, this sort of dovetails into a question that just came into the queue about, can you give the audience a bit of a flavor So he's asking if you buy Apple stock, you obviously have a bid and ask versus buying, Apple debt or Apple bonds. Clearly it's a bit more challenging.
Right. Yeah. When you first of all, here's a big difference. There's only one Apple stock. There could be 50 different bond issues with Apple. When's the maturity? What's the coupon rate? What's the structure of the issue? So you won't see, like, you go online, what's the price? So you really can't see it as well you would see equity. There is a market for it. You can get a bid and ask, but it's not published as easily as equity is published. It doesn't mean you can't sell it, but let's face it. One interesting thing about bonds is that if you buy a 10-year bond and your plan is to hold it for 10 years and get the interest, the day-to-day doesn't change, because there's one beautiful thing about a bond that a stock doesn't have, and that's called the maturity, which we'll get to in a few minutes. So I always say that to people. I go, what are you worried about? You're going to hold the bond for 5 years. You're going to get the money back in 5 years. Well, how do I know? It's the U.S. government. They will pay. That's correct. Okay. This is a really interesting chart. It shows the volatility comparison between equity and debt. The green line, a lot of movement there, right, Michael?
Absolutely.
A lot of movement, that's equity. And you can see there are plenty of times where the market's dropped, again, to go back up. But if you look at the bond market, it is very, very stable. It moves, but nowhere near as much as the equity market. You won't see a bond drop in half. You won't see a bond drop 10%, because the key with bonds is the general level of interest rates and pretty much the general level of interest rates, as well as the credit. And the credit doesn't change that often. The main thing is interest rates might change, but we'll go through that in a few minutes.
And again, at Palisade, as an active manager, we sort of use volatility as an ally. Most people run away from the volatility, they're afraid of the volatility. We do the exact opposite. By knowing what we own, we kind of use the volatility as an opportunity to add to our position selectively.
And the other thing, which we'll get to a little bit more in detail in a few minutes, is some people are always worried, interest rates are going to go up. Is that bad for me? It's terrible. May not be terrible. Actually, you can use it to your advantage, and we'll show you that in just a few minutes. Okay, so this is really important because I want to make sure that people are comfortable with the terminology. So first, terminology is called par value, and that is the amount of the bond. So each bond generally has a par value of 1,000. So if someone says, I own 20 bonds, that's $20,000 worth of bonds, but it's actually 20 bonds, each with a par value of 1,000. Some bonds might have a 5,000 or other par value, but generally speaking, par value is $1,000. Next is the maturity. When will you be repaid? So it's spelled out the month, the day, and then the year. And most are either the 1st or 30th or in the middle of the month. So it's not like, June 26th or something along that line. And remember, issuers don't pay it forward. They pay it back. So you'll get your money back at the maturity date, and the coupon rate or interest, it's stated annually, let's say 3%, which is $30 per year. But one of the great things is you get paid twice a year. So think about it for a second. You get $15, you reinvest that $15. At the end of year one, you got more than $30 because you got the 15 plus the 15 plus the reinvested interest on $15 for 6 months. And just to see that in a simple way. And lastly is the term is based on the maturity. Is it 5 years? Is it 10 years? You use the term in the bond industry, a 10-year note, a 20-year bond, a 30-year bond, to refer to the terminology. One last point is that when we have this, this term rate or 3%, and I want to kind of get rid of some of like the terminology hysterics, let's say. So someone says to you, oh, I have a 3% bond. Great. Oh, now interest rates have risen. I can buy a new bond at 3.5%. So I'm going to earn $35 a year versus $30 a year. That's a benefit. Number two is this. Some bond professionals may use this terminology called basis points. Basis points is simply percentage. So if a bond was at 3% and now it's 3.50%, the increase is called 50 basis points. 100 basis points is equal to a percentage. Let's not make this any more complex than it really is. Okay, who issues debt or fixed income securities? There are three main issuers. Now we're going to start with the following three buckets. One, many, not that many. Let me explain what I mean. One, the US government is an issuer of bonds. And what they do is they use this terminology, they ride the yield curve, which means they issue short-term, intermediate term, and long-term securities. That's their menu. The short-term, which mature in less than a year, are called T-bills or treasury bills. Next up, from anything beyond, usually like 1 to 10 years, are treasury notes. And last but not least, are treasury bonds, which are 30 years of maturity. And they are backed by the US government. The ability and full faith of the US government. And the US government has something I wish I could do, and that's called print money. So they will pay you your money back. Treasuries have no credit risk. I mean, they're rated fine, but the Treasury US government is never defaulted. Next up are municipals or munis, and they separate into two classifications: general obligation bonds and revenue bonds. So let's go through a couple examples. Think of where you live in terms of general obligation bonds: states, cities, counties, and then towns. So within one state, let's say the great state of maybe New Jersey, where I reside.
You're being kind.
Thank you very much. There could be thousands of issuers. And you multiply that by all the states. So we have some issuers that are very large, like New York City or New York State or New Jersey, and then small issuers like towns where maybe a small town like Woodcliff Lake, hypothetically, could issue bonds to raise money. So general obligation bonds are issued by what's called political subdivisions. And they're backed by the full faith and credit. Generally, the money that's collected is the various taxes that we pay. And then we have revenue bonds, which are backed by projects. So, for example, beautiful bridge behind me, the George Washington Bridge, that's backed by revenue bonds if they need to fix it up or repave it or structure it differently or refinance it, as well as you go to the airport. You see a brand new terminal. It looks really nice. How is that financed? Most likely some type of revenue bond where the revenue from the project, from the tolls, from the payments of the airlines make to the airport, backed by that. And the main buyers are two. One is mutual funds, large corporate, large investments, as well as individual investors. And many individual investors, yes, buy individual municipal bonds. Some local, they buy their own town or own state. What is the advantage? I get this question a lot. Todd, what is the advantage of buying bonds within your state? Well, you got a lot of choices. Think of New Jersey or New York or California or Texas or wherever you live, or Florida or Connecticut. There are hundreds of issuers. Here's the benefit. Municipal bonds are generally exempt from federal income tax. The bonus is that if you live in that same state, you get federal and state. If you live in New York City, it's federal, state, and local. So, for example, if you bought a bond that you had to pay tax on, and let's say between income taxes, it could be a tax of like 50%. With a muni, municipal security, you receive all that interest income, and it's not taxed. So, on the last one are corporations, like large corporations like Hewlett-Packard, Apple, IBM, things like ExxonMobil and things like that. They're issued by private corporations, and the money can be for increasing capital expenditures, refinancing, maybe making an acquisition, a variety of things. And there is some default risk, but we're going to see it in a few minutes. The default risk will be very low depending on the credit quality of the issuer. And I know that Palisades Capital tends to look at more of the investment grade in some cases.
Correct. Todd, a couple of questions came
Sure.
from the queue. if someone's in a cash crunch, it appears that the treasuries would be the most likely source to generate some additional funds. And secondly, how would one go about purchasing treasuries? Is there an auction process you could talk about?
Sure. Well, people can buy treasuries directly through the auction, or even though I know about the auction, it could be a little mind-numbing for some people. So a lot of big investment firms, like, for example, a clearing firm like Fidelity might participate through the auction, and they would then be able to market those securities through companies like Palisade Capital. But they do auction, and treasury bills could be auctioned every week. Some of the longer term securities might be auctioned every quarter. So there is it's interesting. The big institutional firms, the big investment banks, will always show up at the auction with what in hand? Money to buy the securities from the government, who then resell them to the public. Any follow-ups on that?
All set.
You got it.
Thanks.
You're very welcome. Hope everyone's having fun. I'm enjoying this presentation. So let's go through some more great yield curve, the infamous yield curve. What this depicts is, based on the maturity of the bond, what is the yield? So you can see that on the bottom, it's very flat, and that could change. And then towards the end, it steepens. So if you look here, it says 1 month, 2 months, 3 months, all the way up to 30 years. So the yields on 1 month, 2 months, 3 months is very, very stable and very, very low. But if you go out to the yield curve at the 30-year, it's 2.37%. Now, that could change. What could happen if, in some cases, the Federal Reserve Board takes an aggressive approach to fight inflation? What you might see is the whole yield curve rising. But the short side of the curve tends to rise a little more because the rates change so often. And that can happen. Unfortunately, there's been sometimes we have something called an inverted yield curve, where rates are higher in the short term and then lower in the long term. That doesn't happen too often. This is referred to as, this curve here is called a positive sloping or normal yield curve, because yields are higher in the long term and lower in the short term. And what happens is that most other issuers, so this is a treasury, let's say, the yield that a corporation would have to pay is usually somewhat higher than the rate that the U.S. government has to pay. The riskier it is, the higher the differential.
Great. Todd, a question just came through.
Sure.
You mentioned Fed policy. They're asking, they hear a couple of terms being tossed around, hawkish and dovish. Can you maybe give the audience a flavor of what those two are?
Hawkish and dovish, yes. Hawkish refers to being very aggressive in fighting inflation. What the Federal Reserve Board doesn't like is runaway inflation. So hawkish means, okay, we want to fight inflation. How do we do that? We raise rates. If we help to raise rates, people will spend less money. It will cost more to borrow money, and you won't borrow as much, both individuals and corporations. Dovish means, hey, let's relax a little bit. Let's try to lower rates for more spending. So hawkish and dovish refers to the policy. There are people on the Federal Reserve Board that are more hawkish. There are people that are more dovish. The idea is they should try to be, in most cases, separate from the other policy called fiscal policy, which is taxes and the U.S. government spending. And they try to be more independent.
Sure. And the other question, you already answered, that question regarding inverted yield curve, you already covered.
Yes, yes. It's scary, inverted yield curve. I won't say when I went to college, but when I did go to college, there was an inverted yield curve. It was a few years ago.
2010, right?
Yeah, sure. Thank you very much. Yeah. You're very kind. You're very kind. I'm hoping one day in the future we'll be able to teach and there'll be an audience so we can kind of play with the dynamics. Seeing you in a camera is nice. Seeing you in person is much better. Okay. This is a great slide of understanding yields. So we have here in the middle, it looks like a parenthesis sign. That's referred to as the coupon rate, the 3% we talked about. And then we have the dollar sign, which is the current yield, which is the annual interest one would receive on the bond divided by the current market price, which doesn't change that much. Remember, the annual interest doesn't change at all. And the market price of a bond doesn't change that much. So the current yield on a bond doesn't change that much, where it could change quite often on a stock as the stock price fluctuates. And lastly is if we took our money, invested in a bond, reinvested all the coupons, and we factored in when we bought it below par or above par, called a premium or discount, and if we held that bond to maturity, what would our return be? That's referred to as the yield to maturity. And that's one of the things you really look at most. So when I look at a bond, and I look at, if someone says to me, hey, what's the bond yielding? Most people refer to the yield to maturity. And the term premium and discount refers to the following. When interest rates tend to fall, bond prices rise. And when rates rise, prices fall. If a bond is selling below 1,000, let's say $900, $800, that's called a discount. If the bond is selling at more than $1,000, $1,050, $1,100, $1,150, that's referred to as a premium, above par, below par. And that will change based upon the level of interest rates. Remember, if there's a 10-year bond, rates are going to change over that 10-year period. The bond's return might change. But again, if you hold the bond to maturity, you will receive at least that return.
Todd, quick question from the audience.
Sure.
Question for Professor Todd is written here.
Professor Todd,
yeah.
Thank you.
I guess question they want you to tie in a topic we covered in the last session. Can you explain the difference between current yield versus a dividend yield?
Yes. So dividend yield is the dividend divided by the current market price. And we use that term dividend yield, and the current yield is actually the same formula. Mm-hmm. It's just two different ways of saying the same thing. Right. So the dividend yield is the annual dividend divided by the current market price. The current yield is the annual interest divided by the market price of the bonds. Again, the differential is the market price of the equity and the market price of the bond are one's going to be much more stable, the other is going to be much more volatile.
Right.
And we talked about credit risk. We rely on this generally Standard & Poor's and Moody's. These are credit rating agencies that rate one thing. They only rate what's called default risk, the risk that the issuer will or will not make the payment. So it goes from, again, I know in school I never got more than an A. I did get some A's, but the best here is AAA. Then we have AA, single A. There's also A+ and B+ and things like that. And Moody's uses the lowercase. So they're very similar, not identical. You might hear the term split rating, where Moody's has one rating, S&P has a little bit different. So we have high grade or investment grade. And there are many institutional investors, by the way, who are only permitted to invest in investment grade securities. Then we have medium grade, and then we have speculative or high yield to some people. That doesn't mean they won't pay. And most of the time they will pay. They're just not as safe. So if you look down towards the bottom, it says historical average investment grade default is less than 1% versus the speculative grade, which is 4%, which is still higher than less than 1, but not that high. And even in 2020, which was, again, there were some bankruptcies. Some of you may have just read about Hertz that went bankrupt. They just got listed again. Reemerge. It happens. It's called Chapter 11. It's called restructuring. In 2020, the default rate was high, but again, that was 8.5%, which means that if you had a diversified portfolio of bonds, you might have had some issues. But again, all in all, you'd be in good shape. This is very, very interesting. So let's do the following here. What I'd like to do is explain the three risks and then go back up to the chart. Reinvestment risk is the risk that when you reinvest the money you're receiving every 6 months, the rate at which you're going to receive changes, which is interesting because if interest rates rise, you'll earn more. So for example, if you bought a bond when interest rates were low and you're only earning, let's say 3% or even 2% or 1%, and then rates rise and you're going to still hold the bond, let's say until maturity, that coupon you receive, when you go out and reinvest it and let's say, put it in a money market fund or whatever it is, that rate is going to rise and you're going to earn more money. So the reinvestment risk could be beneficial if rates rise. Interest rate risk is the risk that if rates rise, the bond's value will fall, and that will happen. But here's where I learned not to get nervous. So you buy a 10-year bond. Your plan is you don't need the money. You might need the money, but all in all, you don't need the money. You're going to hold it for 10 years. So you look at your account statement. 7 years later, you say, oh my goodness, it's worth less than $1,000 because rates have risen. But in essence, as you get closer to maturity, you're going to get that $1,000 back. So it's a very interesting thing. So with equity, you don't get your money back. You get your money back when you sell. With bonds, you can get your money back because there is a maturity, there is an end date. But you got to give up something. And that's one of the things you give up is there will be inflationary risk. Because the $1,000 you get back isn't going to be worth the same as $1,000, but you have the interest every 6 months plus the reinvested amount, so you will earn a good return.
Plus, you have the ability to reinvest at a higher rate, clearly.
Yeah, definitely. And if you see the chart above, green is good, red is bad. Simple. So, for example, with a bond with a high coupon, reinvestment risk is going to be great because you're already receiving a high coupon. With a lower coupon, it's beneficial because you can get a higher coupon. Higher coupon bonds have less interest rate risk. Again, because a lot of your return is based on the coupon. And inflationary risk is going to be lower with a higher coupon bond and higher with a lower coupon bond. And on the other side, the maturity. The longer the maturity, the reinvestment risk is going to be a positive for you. You have less reinvestment risk, but you're going to have more interest rate risk and more inflation risk. And if your maturity is very short term, a year, a couple of years, you're going to have more reinvestment risk, but lower interest rate risk and lower inflationary risk. So again, this is something that we're in a little bit of a time crunch. Knowing that I like to speak a lot, I can spend a lot more time on this, but I do have to move on. Okay. Hybrid securities. Hybrids are going to be convertibles, callables, and preferred. These are still fixed income. As we mentioned in our previous class, I looked at convertibles in like somewhere between a stock and a bond. So the issuers of convertibles are usually either small cap or mid cap, not large cap, because large cap companies don't need to issue convertibles. So with a convertible, you as the investor saying, you know what, I'm willing to accept a lower coupon in exchange for making money if the stock goes up. So with a stock, you generally make money if there is a dividend, but the capital appreciation. Bonds, only generally the interest income. This is kind of like an intermediate step. And convertible bonds can be a great way of kind of tipping your toe in the water without getting fully involved in the equity market. Now, some of you have mortgages. They might be a 30-year mortgage or a 15-year mortgage. How many of you actually pay off a mortgage in 30 years? It's called very few people. You like to pay it off early. Well, that's the same thing an issuer could do when they call a bond. So if a bond is callable, they have to announce it when the bond, it's in the information about the issuer. A bond that's callable allows the issuer to redeem the bond prior to maturity. In some cases, though, they will give you what's called a premium. So a 10-year bond can be callable in 5 years at something called 102. So 102 would mean $1,020 per $1,000 bond. So they will compensate you for the privilege of redeeming your bond early. And generally, they will redeem bonds early when rates drop. So if rates do rise, there'll be less calls. If rates drop, there'll be more calls. And lastly is preferred. It's got the word stock in it, but preferred stock, I think interesting story about preferred stock is there was one time where I had to teach a class at a certain investment firm. And they said to me, well, we want you to go to meet us on the same trading floor where preferred stock is. I said, okay. So people say, well, isn't it the equity floor? I go, no, it's the fixed income floor. So I didn't get lost because I knew exactly where I was going. So preferred stock, even though it has the word stock in it, generally it's issued by not that many corporations, banks, insurance companies, maybe some oil and gas companies. or utility companies where it's a stock, it doesn't have a maturity, but people buy it because of the dividend. That's where the dividend yield is important. And one differential, bonds pay interest semi-annually, but preferred stock pays their dividend quarterly. So that's another interesting differential.
Just two quick observations.
Sure.
Quick plug for Palisade.
Why not?
Yeah, exactly. We have, when you said convertible, at first I thought you were talking about the car. I guess not. We've been managing dedicated fixed income portfolios for using convertible bonds since the mid 80s. It's really a specialty within Palisade, and that will be one of the, we'll have it later on, we'll have a special course within PalCap University on converts. It's really unique hybrid security. And then secondly, real quickly, as you mentioned before, typically when you talk about bonds, about par amount, typically dictated in $1,000. Typically in preferred stock, they issue it at $25.
Right, a lower value. Yes. I'm sorry about that. I should have mentioned. Thank you very much.
But also preferred stocks, as you would imagine, are also super sensitive to any change in interest rates as well.
Correct. So for example, if you own preferred stock in a company and the company had its common stock moved a lot, preferred stock wouldn't move that much. Right. Preferred stock would move generally inversely to the level of interest rate, right, just like regular bonds.
Level of sensitivity.
Exactly. Different sensitivity. Okay. We want to quickly mention the various types of investment. We looked systemic and systematic risk and unsystematic risk. Systematic risk really refers to being exposed to the market. Unsystematic risk is individual. So, for example, all fixed income securities have the systematic risk: purchasing power, inflationary risk, reinvestment risk, interest rate risk, exposure to the market risk, and exchange rate risk, meaning that the value of foreign currencies to the US dollar. So systematic risk is for every bond portfolio. Where does good portfolio management come in key? The unsystematic side. The business risk. Which companies do you choose? The financial risk of those companies. What's the level of default risk? Remember, if interest rates change, interest rates are going to change. But the idea is if you have a portfolio of bonds that are not defaulting, then it's not a major concern, assuming, again, you're holding the bond to maturity. Some small issues could be less liquid. There could be more liquidity or market risk in that respect. And yes, credit risk. And unfortunately, there could be some event risk, like a major flood or earthquake like that could hurt insurance companies. An oil spill could hurt those type of companies and things of that nature. You know, event risk refers to a one-time event that hurts sort of like the companies in that sector.
Think of event risk, I think of the 9/11.
Yes,
I think of COVID. I think of it could be the outcome of an election.
Right, like hotel stocks and things like that, and travel related during that, or restaurant related. Yes, exactly. And then never forget about very important diversification. Key. So we look here's the correlation between stocks and bonds. Between large cap, small cap, and mid cap, there's a high correlation, which means if they generally go up together, they go down together. And the same with bonds. If they go up together, they go down together. But what the interesting thing is the correlation between bonds and stock. There's not as high a correlation, which means, moral of the story is diversification is key. You can't put all your money in stocks or all your money in bonds. There's got to be some mix. Now, based upon certain models, you'll have a much higher percentage in equity or a much higher percentage in debt. But it's important to know that if everything is correlated together, you're going to move with the flow of the ups and downs. It's good to have things that aren't so well correlated. And if you see here, like high yield corporate debt and U.S. mid cap actually have a negative correlation, which is pretty interesting. And convertibles are highly correlated to the U.S. To the U.S. equity market because they are that hybrid securities.
Ultimately, this ties back to getting to know the client, again, the risk profile, the risk tolerance, cash flow needs, et cetera, and it really ties back to the asset allocation.
Mm-hmm. Definitely. Speaking of asset allocation,
that was a cue.
Called the segue in our business. Asset allocation, and this is a moderate asset allocation of fixed income and equities, 40% fixed income, 60% equities. Again, based upon your age, what's your investment objectives? What is your risk tolerance? Is very important. What's the mix? Again, there could be two people with the similar ages, similar income, similar, but their asset allocation could be different. Not drastically different, but definitely different. And within the asset classes, the left-hand side is simply broken down into stocks and bonds. The one by region is a little bit better because we look at really being very granular in terms of what we look at: large cap equities, mid cap, small cap, international, fixed income, high yield, convertible, and even within the fixed income, some type of mix between the various issues.
And again, when we think about the asset allocation, it's looking at not only the holdings within PalCap, but also holdings within external managers.
Yes.
And it's really important to view it as if it's one on a consolidated basis. And of course, we'll rebalance over time where appropriate. Of course, you're taking into tax considerations as well.
Yes. And one of the goals of today's session was to make people more comfortable in understanding the terminology. Sometimes you're at you're in a conversation, you're at a dinner table, whatever the case may be, or speaking to people, and they use terms, and they use terms that are not difficult to define, but they don't know that you don't know those terms, and you're lost. And if someone simply explained the terms to you at the beginning of the conversation, you're going to be more apt to understand what they're referring to. And I think that's the goal of, to me, in financial education, the vast majority of people that I teach are people in financial professional world, but a lot of them are newbies, new to the business. And the goal is to teach them or educate them into the financial service world so they understand the terminology so they can explain to their clients as well. And that's one of the goals, because, again, as we mentioned earlier, in our previous session, besides one's health, financial health is very, very important. And people, it's a good idea for people to be comfortable with the terminology. They rely on an expert, such as Palisade Capital, to go through the weeds, but they have a general understanding of the terminology. Says, "Oh, I have money. What do you do with it? I have money." So the idea is that you don't have to have an in-depth understanding, but some of the basic terminology would be nice to know. Not for everybody, but for a lot of people. And the people that want to know should be able to have that education.
Again, the same way someone goes for an annual physical, they really should go for their financial checkup.
Yes, I like that. Yeah, even sometimes more often than annually.
Correct. Todd, in the last few minutes, a couple of questions have been submitted in advance, and I thank you for those who have done so. The first question, can you please explain the importance of the 10-year Treasury? It seems to be the major benchmark in bond land.
Yes, it is, but not always was. It used to be the 30-year was the benchmark, and then the 10 years important is, number one, when you go out a mortgage, the rate in which you pay is based upon a benchmark. What's that benchmark? The 10-year Treasury note. If IBM is going to issue a bond and it's going to mature in 10 years, which a lot of them do, then they're going to base it off the 10-year Treasury. So it's sort of the bellwether, the standard on which, in the equity world, you talk about like the Dow, the S&P. Well, in the bond world, you talk about the 10-year Treasury note.
Great. Next question up. Todd, are muni bonds appropriate for a specific type of account?
Yes. They're, generally speaking, municipal securities are for your regular account, not a tax-deferred account. You would not buy tax-free securities in a tax-deferred account like a 401k or an IRA or some type of pension plan that you might have. And they're generally most applicable to high-income earners based on their tax rate. I always say that there's something called the taxable equivalent yield formula. And it's the main tool of a salesperson on municipal securities, because what it is you take the yield on the muni and you divide by what's called the complement or percentage differential between your tax rate. So if your tax rate is 50%, the complement of 50% is 50%. And if the muni is yielding 5%, 5% divided by 50% is 10%. That's the taxable equivalent yield. So the higher your tax rate, the more advantageous it is to buy munis. As one person said, not me, it's not what you make that's important, it's what you keep that's important.
Todd, what are the advantages for a corporation to issue a straight bond versus a convertible bond, i.e. is a convertible bond a cheaper form of finance?
Yes, First of all, those issuers that are not experienced in the debt market might have to pay a much higher rate. And they say, well, I can't afford to pay a rate of 9%. How can I get that rate lower? Well, the way to get it lower is give people more, give investors more. So if you make it convertible, you're giving them two ways to make money. One, capital appreciation on the stock. Two, the interest payments. So the reason a corporation would do that is to lower the rate. Think about it a second. There are some people who need a cosigner of a loan in order to get a loan and pay a reduced rate. Same type of thing.
If stocks have symbols, I know you've referenced Tesla, not only this class, but last class, I know that the ticker symbol there is TSLA.
Yeah.
How would one identify a bond security?
Well, the best way is called an identification known as the exciting world of the CUSIP number. That's QSIP is, so if IBM had 20 bonds, each of those 20 bonds would have a different QSIP number.
Right.
And one more thing,
yes.
In the bond world, sometimes they say, hey, which bond is it? Oh, the bond maturing June 2026, that has a coupon rate of X% or something along that. But the best way to identify is called the QSIP number.
Great. Questions came in also before the session. Can you explain the term credit spread?
The credit spread is actually something we briefly mentioned. So for example, if IBM is going to issue a 10-year note and the Treasury is paying, let's say, 2%, well, IBM has to issue a bond at a higher rate. The credit spread is the difference between what corporations pay or the U.S. government and what the U.S. government. The riskier it is, the higher the spread.
Right.
And spreads can widen and narrow. So credit spreads could widen if there's a lot of volatility in the marketplace. They can narrow if there's less volatility in the marketplace.
Right. Todd, can you obviously, given the environment we're in today with rising rates and obviously a bout of inflation in front of us, can you please explain? I've heard of a term called TIPS, TIPS. What exactly is a Treasury inflation protected security?
Well, the U.S. government had notes, bills, and bonds. They said, wait a minute. There's inflationary risk. Maybe what we can do is create a security that the principal will keep pace with inflation. So, for example, let's say a regular bond, $1,000 bond, 3%, at maturity you get $1,000. What a TIP does is add one really interesting feature. The principal, not the interest percentage, the principal will increase annually based on inflation. Let's say, for example, inflation at the end of the year is 5%, measured by the CPI, Consumer Price Index. Two things. One, at the end of year one, the maturity value won't be $1,000, but will be 5% more or $1,050. In other words, an extra 5%, and it will keep growing. The other thing is, although the 3% doesn't change, you'll earn 3% not on $1,000, but 3% on $1,050. So the principal will increase based on inflation. So the coupon rate would be less because you're getting that bonus.
Sure. And the final question, Todd, for you. Why do growth stocks, and you think of typical, I know the FANG stocks come to mind. Why do a lot of the growth stocks tend to lag when interest rates rise?
Because growth stocks are mainly based upon future expectations and lower alternatives. When the market is good for bonds, it's less likely people will use that money to buy stocks. And which stocks they tend to shy away from mostly would be the growth stocks.
Right. And again, growth stocks typically are viewed as more of a long duration type of bond.
Yes.
So clearly, as rates move up, it'll hurt their future cash flow.
Right. The idea is in a low interest rate environment, people will invest more money, look for a higher return. The higher return would be on growth versus value, because the expectation is these companies are going to grow at a much faster rate.
Great. Todd, once again, it's been an absolute pleasure. Thank you for coming in and teaching the class, and thank you for all joining us today.
I'm loving this view. I'm like,
as long as you have to cross the bridge and pay the toll, we're loving it as well.
Yeah, this is good on this side of the bridge. I'm on the Jersey side of the bridge. It doesn't not costing me anything. But on the other side of the bridge, it'll cost me something. So this is great. Thank you very much.
Again, thank you for joining us, and there'll be more courses coming down the pipe. Please stay tuned, and if you have any suggestions or any specific topics you'd like us to join, we're happy to address. Thank you very much. Great seeing everyone.
Enjoy your day, and nice spending time with you.
Bye now.
The information contained in this webcast reflects the views of Palisade Capital Management, LLC, as of the date of its original broadcast, and such views are subject to change without notice at any time. All information provided in this webcast is for informational purposes only and should not be considered investment advice or recommendation to purchase or sell any specific security. While the information presented herein, including information obtained from third parties, is believed to be reliable, no warranty is made concerning the accuracy of such information. There can be no guarantee that any forecast discussed in this webcast will be realized. Consult your financial advisor before making any financial planning or investment decisions. Past performance is not a guarantee of future results.